Hello and welcome to another episode of Beyond the Road, the transportation industry podcast where we talk all things transportation and logistics. Joining me today to talk about the trucking industry during March and kind of give us a synopsis or an overview of what the heck is going on in the truckload freight market is Reed. Reed's been on the podcast before, but Reed, thanks for joining me again.
Anytime.
What do you do at ATS, Reed?
I am the corporate pricing manager. Most of what my group does is contract freight, RFQ pricing. We also do, CRM, customer management, spot recommended rates, stuff like that.
Okay. It's a busy time of year for your team?
Very, yeah.
What are you quoting?
So we see RFQs from our flatbeds, dry-vans, logistics division. So flatbeds typically are really busy at the end of the year, so we just got over that hump. Now dry vans are really hot. They're popping right now.
People are trying to lock in contracts for the extended future?
Yeah, they see low rates, they sniff it out, and they come out, lock it in for a full year. That's their goal.
Well, the last time we talked to you was in November, I think. I think it was early November, late November. We were heading into kind of what we were hoping would be a retail peak. What has changed since we talked in November? When we were, 2023 had been a difficult year. Is 2024 kind of a difficult year from a rate perspective thus far?
Loaded question.
Okay.
Yeah, since November, it's kind of the same old. We're same trajectory as we were at that point. 24 outlook, is pretty much in question. We kind of compare it to what we saw in 2019. Where flat year, heavy on the contract side, a lot of carriers locking in rates at, specific price points and keeping their assets happy.
Yeah. Is that all coming off of, I know we touched on it before, but when did the severe drop in spot rates start to happen?
Severe drop, depends if you look at flatbeds or dry vans, but
Sure.
2022, is when we started seeing things fall off the map a little bit. Flatbeds try to hang on a little bit, so their drop came in 23, and they're still seeing a pretty significant drop right now with the new rates that we're locking in.
Yeah, current state, are spot rates lower than they were last year?
Yeah.
They are, across the board?
So spot rates, January 23 versus January 24. Dry van spot rates, we're looking at a 10% decrease, and then on the flatbed side, we're looking at over a 20% decrease of where they were at a year ago.
Wow. What are the contributing factors to that?
There's a lot. There's the overall capacity is just hanging on. Not a lot of carriers or drivers are exiting the market. And then overall load demand is just stagnant. There's not a whole lot of shipments to be had. There's not a lot of expansions going on with inflation and interest rates, so there's not a lot of projects starting up. Just that imbalance between the amount of drivers and loads that are out there. Yeah,
can you talk to me about what drives the demand in the dry van market and the flatbed market? And because you said that there's not a whole lot of market demand.
Mm-hmm. It's, it all ties back to what are people buying? What's the current economic standpoint? On the dry van side, we saw our biggest influx of volume in the beginning of COVID when you're going out and buying consumer goods and staying indoors. Well, that kind of shifts to services. And so when your spending becomes other growth buckets, you kind of go towards the flatbed side. And there's kind of a varying level of loads that need to be shipped in that area. So if shippers just generally aren't expanding, or they're not very busy, or they're not selling a lot of goods, or if inventories are too high already, they need to have a little bit of a rebalance, and so load count drops to the trucking world.
Do you anticipate that the next 6 to 9 months are going to be kind of more of the same?
In the next 6 months, I can see rates being very flat for both sides, dry van and flatbeds. Like I said, they're locking in contract rates, and as soon as they sniff out the spot market coming up, they're going to hold off any rate negotiations. Obviously, they don't want to raise their own rates if they locked in pretty cheap. So usually that's a sign for very flat rate year. We've been bouncing along the bottom. Carriers are really struggling, with their costs versus what rates are coming in the door. So 9 months down the road, I think people are going to have a lot of pressure. I think there's not going to be a sustainable time frame for carriers to continue with the rates with where they're at now.
Yeah. Have you found it surprising about how much capacity has kind of stuck around the industry? That's for so long. It's been, I don't know, 18, 20 months, right, of pretty extreme cost pressures.
Yeah. The market's just been troopers, drivers just hanging on, you know. There's small efficiencies that they can find along the way that negate a low rate. Yeah. Staying loaded for longer, hauling shorter miles just because your CPM's higher, staying loaded, getting out of the house earlier, avoiding empty miles. You know, there's things that a trucking company can do to negate a low rate, but it's only so long before you run out of that niche market or other people are also going for it. And so, so capacity's hung on a little too long.
It's really amazing to see. I know, so I was going through our intranet and I noticed that you break down, it sounds like weekly trends in, regional pockets of the United States. Can you kind of give me an overview of why your team is looking at those things? And
yeah, we're trying to give confidence to the, CSRs and sales reps to price competitively, show where ops is able to cover loads easier, so we can get a consistent load count in those areas, fix some holes that we might have on the asset network. So we try to give that information and be the middleman between the operation side and the sales group, screaming, this is what we need more of, go get it. And it's a daily, weekly need, so we try to keep up with that.
Are there any areas of the country that start to become hot this time of year? I know the January to, would you say the end of March is usually a pretty slow time for freight movement? Yeah,
it's usually pretty slow. There's pockets that drivers tend to gravitate towards. So Georgia, Texas, those Southeast and Texas markets are not necessarily hot as a rate standpoint, but where drivers like to be at during this time of the year. Yeah. And so those rates, they're competitive. There's a lot of capacity down there. There's a lot of loads to be had too. But for the most part, those are where drivers like to gravitate towards. But if you're looking for a good rate, Midwest is usually a pretty stout rate. Chicago, throughout this entire, influx of rates and markets has been pretty strong. There's always a lot of freight.
Going into that area?
Yeah, in and out. There's enough volume. It keeps enough people happy. We've seen a lot of success in Chicago markets. So those are the areas that stay strong.
Yeah.
Detroit, Wisconsin are usually pretty good. I mean, the lack of drivers, the people avoiding the cold weather and the ice is just going to make for a better rate if you're willing to stick it out.
Sure.
Vice versa for the Northeast and West Coast. People want to avoid that, with weather. So if you're going to go there, you're going to want a pretty good rate and then get out of there as soon as possible and get to a better market.
Sure. Can you talk to me about what's going on in California?
California. There's a lot of hot topics out of California. I think they're looking at their emissions. So intra-California is going to be really difficult. In and out of California is always a varying rate level. So, you're getting a lot of miles. Typically, you're going to go back into Texas markets or further. So drivers like to see a lot of miles. But yeah, whatever you can do to get in and get out is probably the safe bet right now.
Sure. We're coming into, what would you say the major seasonality is that we're coming into?
Seasonality.
Construction?
Yeah. You're on the early side of construction. We see a lot of different early moves for soil, shingles, lumber, like you said, housing starts. Any projects that might be kicking off early, those are usually a safe bet for the flatbed market to start moving now.
Yeah, produce.
Yeah, people start thinking about that pretty early.
Do you price a lot of reefer freight?
We do. We don't have any asset reefers, so we're pricing strictly to broker those lanes. All sorts of business on the reefer. There's so much seasonality that goes into it. You're kind of pricing against the tide. You're looking at a full year cycle at that point. So it's a little bit different the way we price it.
Are rates steadier in the reefer market? Are they CPMs typically higher?
Typically, you have a premium on your CPMs. Reefers and vans can be used fairly interchangeably. So if you're slow on a reefer, you can always haul a van load on a reefer trailer, depending on what commodities you're talking about and what areas you're at. So the reefer market tends to follow the general trend of a van, with just higher peaks and valleys for that seasonality. But very rarely will it come below a van rate. There's always a little bit of a premium for that trailer.
Sure.
Yeah.
Just shorter supply and added costs.
And they get
costs.
so condensed to certain areas during those times of the year. So if you do have produce coming out of Florida, or if you have anything in California, it's just you have such centralized capacity in those areas. Sure. The rest of the market's going to have a hard time finding a truck at that time.
Gotcha. What about load to truck ratios? Have you seen any concerning trends or anything that's intrigued you the last few months that we've talked?
So compared to last year, they're low. If we're looking just at January 23 versus January 24, we're 10% lower on load to truck ratio on the dry van market, but 30% lower on the flatbed. That's kind of where those rate changes came from. Versus December and November, since we last talked, it's promised there's an uptick. We're going from 8 loads to truck ratio on a flatbed up to maybe 12.
Sure.
If we're talking the peaks of 22 and 21, we're at 80 loads per truck, so it's still not near where we were. But it's a slight uptick from where we were at a couple months ago.
Sure, and that's a good trend for the industry.
Yeah, as long as it sustains. If we're looking at just 1 month at a time, there's so much variability. January was so tough because of all the weather. Like Iowa and Pennsylvania, we had to shut trucks down for a week at a time if they were stuck in those areas. So that influences it. So what does February end up looking like? Is it an actual uptick trend up before we get too excited and say rates are going to come back swinging, Yeah.
Okay, yeah. So those ratios in origin or destination locations, those are significant indicators of rates or drive rates significantly.
Yeah. Those are the two biggest factors. You still have like the cost of operating a truck. Those are things that, if that goes up, your rates are usually going to have to follow. Otherwise, you're going to have a hard time paying your bills.
Yeah.
But really supply and demand are the leading indicators to where the market's at.
Can you speak to the cost of operating a truck and how that's kind of changed over the last couple of years?
Yeah, to an extent, like maintenance, truck trailer maintenance, that's all gone up. The cost of having a lease has gone up. Just the per mile cost that those two things accrue.
Yeah.
Overall expectation of the driver pay, has gone up. Fuel has gone up. So if you're locking on an all-in rate, maybe a couple years ago was a lot different.
Yeah.
So those are the things that you kind of try to negate. Fuel, we try to do a spot quote and keep that live with what this week's fuel is.
Gotcha. Yeah. Pretty up to the moment.
Yeah. Right. Otherwise, you really run a lot of risk with that. So.
It's amazing to me that the operating expenses continue to go up while rates continue to go down. How?
There's so much market pressure. Shippers are in the driver's seat, so they're not having difficulty getting the loads covered, and so they're gonna keep driving that market down and that rate down until I drop my shipping budget by X% this year, and there's always a driver who's willing to do it, and unless those drivers start leaving the market, it's really hard for us to get in there. It's hard for us to even onboard unless we can beat a rate right now. It feels like the premiums of having a drop trailer or capacity or a guarantee or, hey, I have a fleet, a manager, a dedicated truck, those things are out the window and we're all focused on rates right now.
Yeah.
And so we're at the mercy of a shipper right now if we want volume.
Sure. And then, so how does that swing back?
There's always cycles to that. A shipper gets burned with a broker, or, they run an incumbent for so long and that incumbent struggles on a load and service failures. And so you see cycles of that. Market pressure is one. Obviously, if demand starts increasing, then we start getting a little more control. But without that, the things that we're providing are drop trailer service and potentially better service than what you're dealing with. That's our sell. That's kind of like our give and take to a higher rate.
Yeah, because we just have higher operating or overhead expenses than a small trucking company.
Right. And the willingness to take risk varies, between us and them. So, yeah, it's that give and take when they hit a wall with what they're dealing with now, and now all of a sudden they have to turn the page and look at a carrier or an asset. It's a little different.
Sure. So really what we're looking for is capacity to exit the market.
Yeah.
If we're a trucking company that wants to make more money.
Yeah.
We're looking for other people to leave the market, and we're looking for an increase in freight volumes and demand from the overall market, which is driven by economic patterns. And
Yeah, both those things would be major releases from where we're at, reliefs. increase in load count, that means we're avoiding a recession. Is that going to happen or is that possible? If we hit a recession, the trucking market's already been through the bulk of it right now and will probably come out ahead. But that's where you start to see a lot of those decisions and changes and dials being tweaked.
Yeah.
So if loads don't come up, if we hit a recession and volumes are limited and growth rates in America are slow, how does the trucking market raise rates and get back on top? Yeah, then your suppliers need to come down, your costs need to come down, or miraculously your rates just need to magically come up.
Right.
And
there's not a lot you can do to control that as a trucking company. Like you can try to control rates to a certain extent before you just price yourself out of winning.
Yeah, there's a fine line. And like I said, with the shipper in the driver's seat and we're giving a rate out there, like we know we need this rate to keep our driver happy. They have 20% less from the next guy. Why wouldn't they go with that guy? So, yeah, you're kind of at the mercy in that middleman of we need this to operationally function, and the shipper's only willing to pay us that.
Gotcha.
Yeah.
Do you have any advice for shippers throughout this year?
They're all focused on their KPIs. They're making sure that their on-time percentage pickups are, there's no excuse for low levels of service right now. The next guy will do it better and faster. So keeping that in mind, keeping opportunities like dropping trailers and other efficiencies that the trucking market can provide. Yeah. If we have an excess amount of trailers and trucks right now, use them, take advantage of that. Obviously cost is important, but there's other things that you can benefit, from a high quality trucking solution.
Sure.
So
what are the risks, and this is maybe a leading question, but what are the risks of locking in those contracts at historic low rates as a shipper?
You're always going to have like a waterfall system, and that first carrier, the cheapest carrier right now, is not going to make it for a full 12 consecutive months happily.
There's no way. Yeah,
right. So the way I price freight is to service it 9 months of the year and usually take a hit that 3 months and continue to do it. But you're going to have to waterfall to those next carriers as failures come up. And so whether you have a plan in place for that or if you thought that carrier was your one solution, those are the flexibility that you need to have and be able to move on to that next carrier once that rate starts to fail. There's going to be a certain point where that contract rate is way lower than a spot rate. That driver's going to see another opportunity next door to you, and he's going to take the spot rate all day long. So either be ready to negotiate your rates back up with that carrier if you like them, or be willing to move on from that carrier and go on to the next one. So,
anything else about March specifically?
March specifically.
Yeah, we're heading into March. March is a quiet time of year. Seasonal load restrictions are in place in many areas. The country's thawing out. Maybe produce harvest is going to perhaps happen.
Yeah, lots moving. Thawing out's one word, but I don't see any snow on the ground here in Minnesota.
We've been thawed forever for the whole year.
Yeah, we should be more nervous about that.
Yeah.
I think it's the same old. Keep volumes coming out, stay consistent.
End of quarter, what does that mean to you?
End of quarter for me, big relief on volumes as far as RFQs coming out. Yeah. I think those will slow down quite a bit in April, May. People usually get pretty content. And then now it's looking deeper at what contracts are working really well for us, what holes in the network we still have that we need to fill on the network side or the spot board. So that's kind of where our focus will shift as a pricing group specifically. And then just hoping that there's enough loads to go around for the rest of the assets. Yeah.
Is your job harder or easier than it was in 21?
It's different. So volumes have significantly gone up. Yeah. So it's gone from very analytical and in the weeds and being able to take time to be, doing those extracurricular projects to be more efficient and better and smarter as a company to, we just got to grind this out. We got to get as many opportunities through the door as possible. And now we have to find a way to do that as efficiently as possible. So, it went from a very data-minded focus to we just got to win some freight that fits the network. Yeah. And so it's been a little different for our group.
Sure. Cool. Yeah, I just kind of wanted to gauge whether, high rates or low rates are easier for a pricing person.
More pressure with the low rates. Obviously, people want to see a turnaround. People want to see what the light at the end of the tunnel is and when it's coming. And it's hard when you don't know when that is, and when you don't have optimism on certain contracts. And so we continue to find those niche markets and try to get a little bit of win. But there's only so much I can hold you off for before rates just, the only correction to a bad rate is a bad rate. At the end of the day, people are going to start leaving the market.
Yeah.
People are going to get sick of it, and now you're going to be able to bump the rate back up.
Yeah. I'll have to check it out. I think DOT registrations happen on a yearly basis. So I wonder if there was a significant decrease between 23 and 24.
Yeah, that and authorities we look at a lot. Like insurance starts. You know, it's not necessarily companies going out of business. It's how many we're going to enter the market that no longer are going to continue on with that process.
Sure.
And so it's starting to
or
tick
drivers
down.
going back to fleets or something, like an owner operator.
Yeah, right. Sure. What's consistent? What do I know? And what do I, what was I good at?
Yeah.
So, yeah, those things are usually a pretty decent indicator of, capacity changes throughout the market.
Sweet. All right. Well, thanks for coming on here, Reed.
Yeah, thanks for having me. It was easy.
Yeah, no problem. You have been listening to Beyond the Road, the transportation industry podcast where we talk all things transportation and logistics. If you liked what you heard here today, make sure to follow along wherever you listen to podcasts. You can also subscribe to us on YouTube. For more transportation-related content and information, head over to the ATS Learning Hub at atsinc.com/learning-hub. On the Learning Hub, you will find a comprehensive library of answers to transportation's most common questions in the form of videos, articles, podcasts like this one, downloadable tools, and more, all created to help you become the supplier that always delivers for its customers. Speak to you again soon on another episode of Beyond the Road. Bye.
Cue the guitar riff.